So today we're going to talk about what can you and your family do about the current tax situation in America, and how can you protect yourself? How can you reduce taxes? How can you build for the future? Well, I think the first thing that you really have to understand is the national debt itself. Now, there's a lot of opinions out there about how we got here. The truth is, and in our opinion, there's a lot of blame to go around. But the reality is, we have over $34 trillion in debt in the United States. Now, that's a massive amount of money. And recently, there were some articles that came out that said that our national debt is not only huge, but it's growing at approximately $1 trillion every 90 days. Now, what that means is that in 2024 alone, we're going to add $4 trillion to the national debt. Now, what some people would have you believe is that just the top 5% in this country are going to pay for that national debt. Our opinion is, and this is widely shared by a lot of economists, that taxes are probably going to be going up on everyone. Now, there's no free lunch, and when it comes to taxes, you can't eliminate or avoid taxes. But the good news is, through effective planning and really understanding what some of your options are, and there are really a lot of them, how you can substantially reduce the tax bill that you have for yourself and your family and build tax-free wealth for the future. And then what I find is that a lot of people come into our office and they don't really understand the many options that are available to them out there today. And today we're going to talk about one of the more popular ones that even with this particular option, it's widely misunderstood. We're going to talk about tax deferral with things like 401ks versus tax-free growth of things like Roth IRAs and Roth 401ks. Now, I believe what our industry has done is we've done a fairly poor job of educating the folks that we talk to, because we have taught people to defer taxes. And in a sense, what people have done is they have interpreted tax deferral as tax savings. So a good example of this would be when you're in your working years, you put a certain amount of money away in your company's 401k. That is then matched by your company, and that grows over time. So you don't pay taxes on what you put in. And the whole idea behind that is that when you retire, your tax bracket is going to be lower, and so you're going to save money in taxes in the long term. Now, I grew up in a farm, and what I always ask clients is, if you had a choice, would you rather pay taxes on the seed or the harvest? Well, any farmer out there would want to pay taxes on the seed because the harvest is much greater. And it's no different with your assets like 401ks. Tax deferral is not really tax savings, it's really just deferral. So a good example of this would be, if you look at the statistics out there with a lot of people, the goal of most people in America is still to amass $1 million or more. So let's say you work 20, 30, 40 years of your life and you're a good saver, and you save over $1 million, or right at $1 million for you and your family. The good news is you have $1 million. The bad news is that money is not all yours, because once you start using that for income, which is a big deal in retirement, you have to start paying taxes at your ordinary income tax rate. So for example, if you're in a 25% income tax bracket, you don't really have $1 million in that 401k, you really have $750 that belongs to you. Now, I'm certainly not saying you shouldn't have any money in tax deferral or you shouldn't participate in your company's 401k. Nothing could be further from the truth. You do need to be saving for the future. The question is, do you want to diversify how you save money for the future? For some people, this will be a lot. For some people, it'll be none. For others, it will be all of your money. So one of the most popular ways to do that is a Roth IRA contribution. And I've had a lot of people say to me, well, John, I make too much money. I can't participate in a Roth contribution or a Roth IRA contribution. And this is really where the misunderstanding comes in, because there's actually several different strategies with a Roth that you can deploy regardless of your income. Now, the first one, of course, is a Roth IRA contribution. And for 2024, if you're a couple filing jointly, if you make less than $230,000 and you're less than 50 years old, you can put away each $7,000 a year into a Roth IRA. Now, you're going to pay taxes on that $7,000. That's the difference between a Roth and a 401k or a tax deferred account. You pay taxes up front, but the growth of that money is tax-free, and then the use of that money in retirement is also tax-free. Now, there's some time limitations. You got to have it there for 5 years and that type of thing. But in a nutshell, it's $7,000 if you make less than $230,000 a year, married filing jointly. It's $7,000 a piece. Now, if you're over 50, you can actually put away $8,000 a year. So there's some catch-up provisions. And that's a great way to get started to actually start to build tax-free income. So if you have all of your money in a deferred account like a 401k, you might consider taking some of the money that you make, if you're making less than $230,000, and pay taxes today that grows tax-free for the future. And that gives you a little bit of a diversification on your assets and also diversification on your income as you start to take income in retirement. But what about if you make more than $230,000? A lot of folks, believe it or not, here think that they don't have the options that people that maybe make less money do. Well, the fact is you have several options. And this first one applies to whether you're making over $230,000 or less than $230,000. And that's what's called a Roth 401k. It really surprises me that still to this day, a lot of people will walk into our office that have a 401k with their company. Beacon Capital Management, for example, has a 401k. But we've also added a Roth option. So if you don't know if your company 401k has a Roth option, go and talk to your HR director or whoever handles your benefits and ask them that question. If not, ask them if they could consider adding that. And what that means is, just like a Roth IRA contribution, if your company 401k has a Roth 401k option, you can fund that with what you're putting into that. And yes, you again will pay taxes, but all the growth on that money is tax-free. Now, the company match has to go in the traditional side. So that is a little bit of a difference here. But the other difference is there's no income limitation on a Roth 401k like there is a Roth IRA. So if you're in the example that I've been using, married filing jointly, and you make over $230,000, you can participate in your company Roth 401k. Now, there's a couple other options that you can deploy as well. And this next one is referred to as a backdoor Roth. Let's say you're in a situation where you are making over $230,000, married filing jointly. There's what's called a backdoor Roth. Now, what this means is you can take those IRA contributions and put them into a traditional IRA. And of course, that's not taxed initially, and then do what's called a Roth conversion. That's why it's called a backdoor Roth conversion, because we've been talking up until this point about Roth contribution, but there's also Roth conversion, which again starts to really complicate this. And there's no income limitation on a Roth conversion. So if you're a higher income earner, you can put money into a traditional IRA, and then once it's there, convert that money to a Roth. Again, you do pay taxes on that transaction, but then all of that money in a Roth then grows tax-free. So one more that I want to talk to you about today is a Roth conversion, because I think this is really important. It's become really popular with people, and I've kind of got a graph that I'm going to show you that will sort of outline this. And you can really do this at any point, but this has become more and more popular as people approach retirement and get into retirement. Let's say, and this is an example of someone who has $1.5 million that they have saved over a working career in a 401k or an IRA. Now, what you don't realize is that when you retire and you start taking money out of that 401k or IRA, either because you need it or you want it, or you're required to pull money out. Once you get under the age of 73, you have to start taking money out of the 401k, even if you don't need it, or those deferred accounts, through what's called required minimum distribution. I truly believe that when people get close to retirement or in retirement, they do the least amount of tax planning because they feel like they have very few choices. I actually think this represents a time in your life where you have more choices than you've had at any other point in your lives. Now, one of the ones that's become popular that you really need to know about is a Roth conversion. So what this table shows us is side by side the analysis of someone who does nothing other than takes out their required minimum distribution once they reach the age of 73, and then they redeposit the after-tax amount of that required minimum distribution into an account. That account grows at about 4% a year, which is a very conservative return, and then they pay taxes on the return and they die at the age of 90. This is over a life expectancy of 90. We hope you live much longer than that, but you've got to assign an age in there. So what happens is, again, this is based on $1.5 million, and this person is in a tax bracket of around 25%. So you can put any tax bracket in this that you want to. You can put any amount of money that you want to. The principle is the same. If this client does nothing, which I truly believe is the worst thing you can do with the kind of debt we have nationally, and where I believe tax brackets are going to go up, especially when the 2025 tax brackets that we have today expire. If you do nothing, basically, but pull out your required minimum distribution between when you become eligible or have to take money out, and again, if you were to live to age 90, you would pay $417,594 in taxes just on your required minimum distributions if you live to the age of 90. If you were to take that after-tax money and put that into a brokerage account, not saying that's not suitable, but if you were to do that, and then that money also grows at 4% in a brokerage account and you live to age 90, you would pay an additional $142,944 in taxes on the after-tax RMD just based on a 4% return. And then at death, you would be responsible for another $358,807 in taxes. Now, if you add all that up on a $1.5 million IRA, that's a tax burden of over $919,000. That is a lot of money. And that's with tax brackets today, with us again expecting them to go up. Now, a lot of times people will say to me, well, John, are you saying that you can avoid taxes? Absolutely not. You cannot avoid taxes. I've had people actually come into our office that have said, well, I talked to this one advisor and they said if we came to see them, we could avoid taxes. Well, hey, if you can prove that out to me, I'll put my money with them. That just doesn't exist. But you can take control of your future, you can take control of your family's future, and you can use tax efficiency to reduce what could be a very, very big number. If we were just to take the Roth conversion aspect, none of these other aspects, and there are many, but just this one conversion, if we were to take 1.5 million, and I'm not advocating you take 1.5 million and just convert it immediately, but if you were to do that, you'd pay $330,000 in taxes, but then that money would grow tax-free for the rest of your life. So this is a great example of the farming example I used when I said, would you rather pay taxes on the seed or the harvest? You know, I don't know for you and your family, if you have a $1.5 million IRA, if the savings is $900,000, or the difference here is $600,000, but I know it's significant. But what you have to be willing to do is to educate yourself, and not only that, but to demand really solid answers from your advisor. Because here's the deal. I was recently asked a question by someone, hey John, do I really need to understand this stuff, or can I just trust an advisor to do this for me? Well, here's what I think. I think that when you walk into somebody's office and you entrust money that you have worked an entire lifetime for, that you should demand and expect answers and strategies that keep more money in your pocket and in your family's pocket. That's what we strive to do every day at Beacon Capital Management. If anything that I've talked about is something that you would like to get more information about for you and your family, again, this is really about you and your family and your future, we would be honored to walk you through some of these principles. Thanks so much for listening and for your time today.